For most of modern history, the middle class has been described as a moral achievement of capitalism, proof that growth works, that productivity eventually lifts everyone, that stability emerges naturally when markets mature. This story is comforting and wrong. The middle class did not emerge organically, and it does not persist automatically. It was engineered, maintained, and protected because it served a specific systemic function. The middle class was never just a social outcome. It was a buffer. In any hierarchical society, tension accumulates between those who own and those who do not. Left unmanaged, this tension expresses itself through instability, strikes, revolutions, populist movements, or outright collapse. Historically, societies oscillated between elite concentration and mass poverty, with violent resets occurring when inequality crossed a certain threshold. What changed in the mid-20th century was not human nature or capitalism's morality, but governance strategy. The middle class became a shock absorber, designed to sit between the top and the bottom and absorb economic stress before it reached a breaking point. After World War II, this logic became explicit. Western governments faced two existential threats: internal unrest and external ideological competition. The Great Depression had already demonstrated that unbuffered capitalism could implode. The Soviet model, whatever its flaws, presented itself as an alternative that promised dignity to workers. Stability was no longer optional. It was a national security objective. The response was not to dismantle capitalism, but to modify it to insert a stabilizing layer. In the United States, this took the form of policies that were unprecedented in scale. The GI Bill subsidized education and home ownership for millions of returning soldiers, rapidly expanding professional and managerial class. Between 1945 and 1970, real median household income in the U.S. nearly doubled, closely tracking productivity growth. Unionization rates exceeded 30%, anchoring wages to output rather than speculation. Corporate tax rates remained above 50%, financing infrastructure, public education, and social insurance systems that reduce volatility at the household level. This was not accidental generosity. It was systemic design. Europe followed a similar logic through welfare states and social democracy. Universal health care, strong labor protections, public housing, and progressive taxation were not merely ethical choices. They were stabilizers. The goal was to ensure that the majority of the population had steady income, assets to protect, and a future to lose. A population with mortgages, pensions, and career ladders behaves differently from one living paycheck to paycheck. It is more patient, more compliant, less revolutionary. The middle class functioned as a pressure valve. During economic downturns, it could absorb losses without immediate collapse. When inflation rose, it eroded savings rather than triggering starvation. When taxes increased, they came disproportionately from salaried workers rather than capital owners or the very poor. This was not exploitation, in the crude sense. It was risk distribution. The middle class existed to hold risk that neither the elite nor the poor could safely bear. Crucially, this buffer also protected the top. By preventing sharp polarization, it reduced the likelihood that wealth concentration would provoke backlash. Studies of inequality and political stability consistently show that societies with a large middle-income group experience fewer coups, revolutions, and extreme political swings. A World Bank analysis of dozens of countries found that nations with a larger middle class exhibited stronger democratic institutions and more predictable policy environments. Predictability is valuable to capital. The middle class bought it. It also protected the bottom. By lifting a substantial portion of the population above subsistence, it reduced the scale of desperation. Welfare programs, minimum wages, and stable employment did not eliminate poverty, but they narrowed it. The poor existed, but not in numbers or conditions sufficient to overwhelm the system. In this sense, the middle class was not the enemy of the poor. It was the barrier preventing mass immiseration from becoming politically explosive. This framing challenges the idea that the middle class is simply people who earn between X and Y. Income bands are symptoms, not definitions. The real definition is functional. A middle class exists when a large segment of society can meet basic needs, accumulate modest assets, and plan across decades rather than days. When that condition holds, social stress is delayed, diluted, and redirected into manageable channels like elections, labor negotiations, and consumer behavior. The buffer role becomes even clearer when contrasted with societies that lacked it. In pre-revolutionary France, a narrow elite controlled land and privilege while a majority faced chronic food insecurity. There was no substantial middle layer capable of absorbing shocks. When harvests failed and fiscal pressure intensified, the system cracked violently. Similarly, in late Roman Republic Italy, the erosion of small landholders and early middle class led to mass urban poverty, political extremism, and eventually authoritarian consolidation. These were not moral failures. They were structural ones. What the post-war architects understood, and what later generations forgot, is that the middle class is expensive. It requires sustained redistribution, limits on capital's share of income, and institutions that prioritize wage growth over asset inflation. It also requires accepting lower short-term returns in exchange for long-term stability. For several decades, this trade-off was consciously accepted. The result was historically unusual: high growth, low inequality, and political calm. But this equilibrium only worked as long as the middle class remained thick enough to absorb shocks faster than they accumulated. Its strength lay not in individual wealth, but in collective mass. As long as most people felt buffer protected from immediate ruin, the system could transfer costs quietly. Wars could be financed through moderate taxes and inflation. Financial crises could be patched over without total collapse. Structural inefficiencies could persist without revolt. Understanding the middle class as a buffer reframes the entire modern economic narrative. It was not the beneficiary of the system. It was part of the system's infrastructure. Like any piece of infrastructure, it was built for a purpose. And like any buffer, its value only becomes visible when pressure increases. The question is not whether the middle class is declining yet, but whether the system still intends to maintain it. That question cannot be answered without examining how the buffer has been used and overused whenever crisis struck. If the middle class was designed as a buffer, its real function only becomes visible when pressure arrives. Buffers are not meant to shine in good times. They are meant to take damage quietly, so the structure behind them remains intact. Over the past half-century, every major economic shock has followed the same pattern: protect the core, stabilize the extremes, and route the cost through the middle. What looks, in hindsight, like stagnation or decline was in fact continuous absorption. The first major test came in the 1970s. The post-war growth engine slowed, oil shocks hit, and inflation surged across advanced economies. For the first time since World War II, productivity gains no longer translated cleanly into wage growth. In the United States, real wages peaked around 1973. From that point forward, productivity continued to rise, but median compensation decoupled. This gap was not an accident. It was a release valve. Inflation reduced the real value of wages and savings without requiring explicit political decisions to cut pay. The middle class absorbed the adjustment through declining purchasing power, while capital owners retained pricing power and governments avoided mass unrest. The 1980s and 1990s deepened this mechanism through financialization. As wage growth slowed, credit expanded to fill the gap. Household debt in the U.S. rose from roughly 45% of GDP in the early 1970s to over 95% by the mid-2000s. Mortgages, credit cards, auto loans, and later student loans allowed middle-class households to maintain consumption despite stagnant incomes. From the system's perspective, this was efficient. Demand remained strong, profits were protected, and political stability was preserved. The cost future income claims locked into debt servicing was deferred onto the same group that had already absorbed wage erosion. This shift from income to leverage was not neutral. Debt does not burden everyone equally. The wealthy borrow to acquire appreciating assets. The poor are often excluded altogether. The middle class borrows to maintain living standards. As a result, it becomes uniquely sensitive to interest rates, employment shocks, and asset price swings. This sensitivity is not a flaw, it is the mechanism. When conditions tighten, the middle class adjusts behavior, cutting spending, working longer, delaying retirement long before systemic collapse occurs. The housing market became the central transmission channel. Homeownership, once promoted as a pillar of middle class security, evolved into a tool for risk absorption. Rising home values in the 1990s and early 2000s masked income stagnation, allowing households to borrow against equity. When the housing bubble burst in 2008, the losses were not evenly distributed. Financial institutions deemed systemically important were rescued through bailouts and liquidity facilities. Asset markets were stabilized aggressively. Meanwhile, millions of middle-class households lost homes, savings, and years of accumulated wealth. The Federal Reserve's own data show that between 2007 and 2010, median household net worth in the U.S. fell by nearly 40%, with housing losses accounting for the majority. This was not collateral damage. It was a buffer doing its job. The political response to the crisis reinforced the pattern. Governments framed bailouts as necessary to prevent total collapse, which was true, but the distributional outcome was clear. Losses were socialized upward, while recovery was asset-driven. Quantitative easing restored equity in bond prices far faster than wages or employment. Those with assets recovered quickly. Those without did not. The middle class, holding leveraged housing rather than diversified capital, lagged behind. Stability was restored without structural reform because the buffer absorbed the shock. The same logic reappeared during the COVID-19 crisis, though at unprecedented scale. Governments injected massive fiscal and monetary support to prevent immediate collapse. On the surface, this looked egalitarian: stimulus checks, unemployment benefits, business loans. But the long-term effects followed familiar lines. Asset prices surged. Equity markets reached record highs within months. Real estate prices accelerated. Meanwhile, supply shocks and loose monetary conditions ignited inflation. Between 2021 and 2023, real wages declined in many advanced economies despite nominal raises. Inflation functioned as a diffuse tax, eroding purchasing power without legislative votes. Once again, the middle class paid quietly. Data from the OECD show that inflation disproportionately impacts middle-income households because a larger share of their spending goes to necessities like housing, energy, and food, which experience the sharpest price increases. At the same time, higher interest rates used to control inflation raised mortgage and credit costs, further tightening household budgets. The poor were partially shielded through transfers. The wealthy benefited from asset ownership and pricing power. The middle absorbed the squeeze from both directions. Taxes reinforce this pattern. Middle-income earners are the easiest to tax: visible, salaried, and politically fragmented. Capital, by contrast, is mobile and structurally advantaged in tax codes. Consumption taxes, payroll taxes, and bracket creep all fall disproportionately on the middle. Over time, this creates a quiet fiscal transfer that funds public goods, crisis responses, and debt service without provoking the resistance that overt elite taxation might trigger. Again, this is not conspiracy. It is incentive alignment. What emerges from this history is a consistent rule: whenever the system faces a trade-off between instability and middle-class strain, it chooses strain. Not because policymakers are malicious, but because the middle class can bear the longest without immediate rupture. It has savings to draw down, credit to access, skills to redeploy, and social norms that encourage compliance. These characteristics make it uniquely suitable as a shock absorber. Importantly, this absorption is cumulative. Each crisis leaves the buffer thinner. Savings rates decline, debt loads rise, resilience erodes. The system relies on the assumption that the middle class can always stretch a little more, work a little longer, accept a little less, delay another milestone. For decades, this assumption held. But buffers are finite by definition. Their purpose is to be consumed under stress, not to regenerate automatically. By tracing how inflation, debt, Asset cycles and policy responses have consistently routed costs through the middle. The narrative of bad luck or inevitable globalization becomes insufficient. What happened was functional. The middle class did what it was built to do. It absorbed shocks that might otherwise have destabilized the system. The more important question is not whether this process was fair, but whether it remains viable. Because once a buffer loses its capacity to absorb, the pressure does not disappear. It moves elsewhere. By the time a buffer begins to fail, it is tempting to describe its deterioration as accidental a side effect of technology, globalization, or cultural change. But the erosion of the middle class cannot be fully explained by external forces alone. What is unfolding is not simply neglect. It is a structural shift in which the middle class has become less necessary to the system that once relied on it. When incentives change, maintenance stops. For most of the post-war period, economic growth depended on mass consumption powered by rising wages. Firms needed a broad base of solvent consumers. Governments needed a large tax-paying population with stable incomes. Political legitimacy depended on visible upward mobility. In that environment, the middle class was indispensable. But over the past 4 decades, the architecture of advanced economies has changed. Growth no longer requires a broad middle. It increasingly relies on asset appreciation, global supply chains, and technological leverage. Automation and digitization hollowed out middle-skill jobs first. Routine clerical work, manufacturing, and administrative roles, once the backbone of middle-class employment, were either automated or offshored. What replaced them was polarization. High income, high-skill roles at the top and low wage, insecure service work at the bottom. This was not a temporary transition. OECD labor data show a long-term decline in the share of employment in middle-income occupations across most advanced economies since the 1980s. The labor market itself stopped reproducing the middle class at scale. At the same time, globalization altered bargaining power. Capital became mobile. Labor largely did not. Firms could arbitrage wages across borders, while workers competed within national labor markets. This asymmetry weakened unions, compressed wages, and shifted income toward profits. From the system's perspective, this was efficient. Lower labor costs increased margins and stock valuations. The loss of middle-class security was not immediately destabilizing because the buffer still existed. It could be drawn down. More importantly, the growth engine shifted from production to assets. In an asset-based economy, wealth accumulation depends less on wages and more on ownership. Equity markets, real estate, and financial instruments became the primary drivers of net worth. This model does not require a large middle class. It requires a relatively small class of asset holders and a broad base of labor providing services at controlled cost. Consumption can be sustained through credit and transfers rather than income growth. Stability can be managed through monetary policy rather than shared prosperity. This shift has political consequences. The middle class is historically the most demanding social group. It expects fairness, transparency, and mobility. It votes, organizes, and resists overt exploitation. The very characteristics that made it a stabilizer also make it costly to manage. By contrast, a system divided between asset owners and a subsidized service class is easier to control. The poor can be pacified through targeted benefits. The wealthy are aligned through capital gains and regulatory protection. The middle class sits uncomfortably between these poles, too large to ignore and too independent to fully co-opt. As a result, policy priorities have adjusted subtly but consistently. Social spending has shifted from universal programs toward means-tested assistance. This protects the bottom while reducing commitments to the middle. Housing policy increasingly supports asset prices rather than affordability, benefiting owners while raising barriers to entry. Education costs are privatized through student debt, transforming a public investment into a personal liability. Healthcare expenses are shifted onto households through premiums and deductibles. None of these changes announce the end of the middle class, but together they squeeze it from every side. Fiscal and monetary policy reinforce the trend. Low interest rates inflate asset values, disproportionately benefiting those who already own them. When inflation becomes politically dangerous, Rate hikes are used to cool demand, even at the cost of layoffs and mortgage stress. The middle class, concentrated in interest-sensitive sectors and leveraged assets, absorbs the impact. Meanwhile, explicit redistribution upward is avoided rhetorically, even as implicit redistribution through asset inflation continues. The narrative used to justify this transition often frames the middle class as inefficient or outdated. Workers are told to reskill, households to adjust expectations, communities to be more competitive. Risk is individualized. Structural forces are reframed as personal failure. This narrative is not merely ideological. It is functional. By redefining middle-class decline as an issue of adaptability, the system avoids acknowledging that the buffer is being deliberately thinned. Crucially, the disappearance of the middle class does not immediately produce collapse. In fact, for a time, it can increase apparent efficiency. Profit margins rise. Asset markets boom. Public balance sheets look manageable as costs are offloaded onto households. Inequality widens, but volatility remains contained through credit surveillance and targeted support. From a narrow systems perspective, this can appear stable. But what is stable is not necessarily resilient. A society without a thick middle loses its capacity to absorb shocks gradually, instead of stress being distributed across millions of households with modest buffers. It concentrates at the extremes. Small disruptions produce outsized reactions. Political discourse radicalizes. Trust erodes. Compliance weakens. These are not moral judgments. They are predictable outcomes of structural thinning. The middle class is not being erased because it failed. It is being erased because the system found ways to function without it, at least temporarily. The buffer is no longer rebuilt after each crisis. It is consumed and not replaced. History suggests that such arrangements can persist longer than expected, especially when supported by technology and finance. But they also suggest that when the remaining buffers fail, adjustment is no longer incremental. Understanding this shift is essential because it reframes decline as design rather than destiny. The middle class is not vanishing into thin air. It is being compressed out of relevance. And systems that no longer need buffers do not invest in maintaining them. They move on until they encounter pressures that no longer have anywhere safe to go. When a society loses its middle class, it does not collapse immediately. It drifts. Institutions continue to function. Markets still clear. Elites often mistake this surface continuity for resilience. History shows otherwise. The disappearance of the buffer does not remove pressure. It redirects it. Without a middle layer to absorb shocks gradually, stress accumulates at the extremes until it is released abruptly, often violently. The Roman Republic offers one of the earliest and clearest examples. For centuries, Rome's stability depended on small landowning citizens, farmers, who were neither aristocrats nor destitute. They paid taxes, served in the legions, and had a stake in the system. As Rome expanded, war spoils and slave labor enriched elites while undermining these smallholders. Land concentrated into latifundia. Dispossessed farmers flooded into cities, forming an urban poor dependent on grain doles. The middle layer eroded. Political life polarized between oligarchs and populist strongmen. Reform attempts failed not because they were unnecessary, but because the social buffer that could have supported gradual change no longer existed. The Republic did not fall in one moment. It hollowed out, then surrendered authority to empire. Pre-revolutionary France followed a similar trajectory. The Ancien regime was not destroyed by poverty alone, but by imbalance. The nobility and clergy were largely exempt from taxation, while the burden fell on commoners, including a fragile middle stratum of professionals, merchants, and officials. This group was educated, economically productive, and politically excluded. When fiscal crisis struck in the 1780s, driven by war debt and regressive taxation, there was no resilient middle class capable of absorbing the shock quietly. Bread prices spiked. Credit froze. Trust collapsed. The result was not reform, but revolution. Once again, the absence of functional buffer turned a solvable crisis into a systemic rupture. More modern examples reinforce the pattern. In Weimar Germany, The middle class was devastated by hyperinflation in the early 1920s and later by mass unemployment during the Great Depression. Savings were wiped out, status collapsed. The buffer was destroyed twice in a single generation. The political consequences were immediate and extreme. Radical movements thrived not because the population was uniquely irrational, but because a society stripped of its middle has no moderating force. Polarization becomes the default. Latin America in the 20th century provides a slower, more chronic illustration. Countries with narrow elites and large informal sectors struggled to sustain stable democracies. Without a broad middle class to anchor tax bases and institutional legitimacy, states oscillated between populism and authoritarianism. Economic shocks translated directly into political crises. Where middle classes expanded, stability improved. Where they stagnated or reversed, volatility returned. The correlation is not coincidental. Across these cases, the mechanisms repeat. Inequality rises, not just in income but in security. Debt increases as households attempt to self-insure. Public trust erodes as institutions appear to serve only extremes. Politics becomes personalized and absolutist because compromise requires a center strong enough to sustain it. The loss of the middle class does not guarantee collapse, but it sharply narrows the range of non-catastrophic outcomes. What distinguishes the present moment is scale and delay. Modern states possess tools ancient societies lacked: central banking, digital surveillance, targeted transfers, and globalized capital markets. These tools can postpone reckoning. They can mask stress through liquidity injections, suppress dissent through administrative means, and maintain consumption through credit. For a time, this creates the illusion that a buffer is no longer necessary. But history suggests that buffers are not optional. They are structural requirements for long-term stability. When they disappear, systems rely increasingly on forced spectacle or emergency measures to maintain order. Each intervention buys time at the cost of fragility. The absence of a middle class transforms ordinary downturns into legitimacy crises, because there is no broad group left that both bears costs and believes the system will eventually work for them. The critical insight is not that the middle class deserves protection out of fairness, but that it performs a role no other group can replace. Elites are too insulated to absorb losses without backlash. The poor are too exposed to absorb losses without immediate harm. Only a middle layer with partial security and partial dependence can carry systemic stress without breaking the system itself. Remove that layer, and the system loses its margin for error. History does not repeat mechanically, but it rhymes structurally. Societies allowed their middle class to erode did not fail because they lacked intelligence or technology. They failed because they mistook short-term efficiency for durability. The buffer was consumed and not rebuilt. In that sense, the decline of the middle class is not merely an economic trend. It is a signal. It indicates that the system has chosen to spend its stabilizing capacity rather than renew it. What follows is not predetermined, but it is constrained. Without a buffer, pressure no longer dissipates, it accumulates. And systems built on accumulation, without release, do not end with gradual adjustment. They end when something finally gives.